Hey everyone, so I wanted to make a quick video about my latest Instagram and TikTok post. Now there is a simplified version of this schematic in our course, but for those of you that are not in our course, I just want to talk about generally what I look at and how we basically get past the complex Wyckoff schematic, why it's not necessary, and ultimately how you could get in the exact same entries without knowing all that stuff. So, generally we have something that resembles a range, and if they're going up, they'll usually run liquidity at the bottom and then go up, and then they'll come back and mitigate whatever broke out of the range and go up. In the going down schematic, it's generally we go up, run liquidity up here, we go down, we come mitigate whatever caused the breakout of the range, and we go down. That's the only thing you really need to know. How it's going to happen and how many times it's going to go up and down and do this and do that and truly run the range, you don't know. It could sit in a range for 2 weeks, 3 weeks, 4 weeks. It could sit in a range for 3 days. You don't know. What you do know is there's going to be some clues left that are basically saying we're basically leaving the range. So rather than the whole complex Wyckoff schematic and all that stuff, this is the simplified schematic. You have a range, liquidities run, the market's manipulated by the banks. They grab this last bit of liquidity to fill their orders. They break out of the range. They mitigate their range. They leave. That's the concept. The next concept, which is what smart money is based on, especially the way we teach it at Precision Markets, is your flip zones. So, if we're in a trending market, generally one side's in control. So in this particular schematic, supply's in control. So basically you're always looking for what took out that zone. So if we have a demand right here, let's say this is our demand, we'll just shorten that. We could probably actually do this a little bit better so it's not so overlapped. I'll put this over here. Alright, so we have a demand level here. Now, we're looking for what caused that demand to fail. So we're looking for the supply zone. And this is ultimately the supply that flipped the demand. And ultimately, whether a range is created first and this happens, or we're just in a trending market, there's always going to be a supply that flips a demand or a demand that flips a supply. And these are kind of the areas that we're looking to get in these flip zones. And these flip zones happen over and over. You can identify them pretty easy. No, it's not a bulletproof strategy. You still have to manage risk and you're still going to take hits, but these are just higher probability areas. So these are basically your flip zones. And we'll just drag this supply over here. Cool. Now, so if we're in a downtrend, ultimately we want to be selling from a supply. And we want the supply that took out the demand. And ultimately, we want to follow in the direction of order flow. So rather than all the complex Wyckoff schematics and names, this is kind of the more basic version. And then this is the even more basic version. We're looking for flip zones. Now, here's Euro USD. We have a perfect schematic of a range being built, liquidities run. This is your last point of supply, or demand, I should say, sorry. Manipulation happens, they run the highs. Distribution happens, they run the lows, and they're ready to leave the range. Now, why are we looking to go down? This is where market structure comes into play, and you start formulating an idea. And traditional market structure is, basically either trending up or down. Just before we get too crazy on this, let's just look at the 4-hour quick. So on the 4-hour, the last thing we did is put in a new low. So we are currently unconfirmed bearish on the 4-hour. On the daily, the last thing we did, and this is an Lambda chart for anyone that wants to double check. The last thing the daily did was we put in a low, then we became unconfirmed bullish. However, we never got a chance to confirm the trend by making a second high, and we put in another low. So that puts us back to being confirmed bearish, at least on Alanda's chart. Forex.com or FXTM may differ a bit, as these candle bodies and wicks close in different places sometimes. So, looking at the higher time frame, it is a higher probability of selling compared to buying. Next thing we're going to look at is 4-hour pricing. 4-hour pricing says we are in premium. We're above 50% of the last impulse. Again, probability says it's higher chance to go down at this point in this exact day. Next thing we have 15-minute market structure. I'm going to bother showing you, but this is a 4-hour supply. Just take my word for it. I did have this marked out last week. It's a 4-hour supply. We tapped into it once. It failed. Tapped into it twice. Failed to run again. So at this point, what we can assume is this low becomes weak. This high becomes strong. And this low becomes weak because it failed to run the high. So now that we made one low and we are unconfirmed bearish, what happens now is we've again realigned ourselves with higher time frames. So this becomes the short-term target. This becomes the long-term target. How many ranges it decides to create in between and go up and down is completely up to the market. I can't predict that. But as of right now, that's target 1 and that's target 2. Obviously, any trade you get into, you're going to pay yourself along the way. And you're always just, as a day trader, you're always going to be taking something off. So, going to this schematic again. So this is kind of our simplified Wyckoff schematic. And more importantly than that, it's just identifying where the orders are stacked, when the liquidities run, and when we're ready to leave the range. And we're identified by these flip zones. Now, if we just go to the 1 minute, again, we make a high, and right here, you get your chop complete. Cool. Let's say chop bottom, and basically this is the zone that caused it. Depending on how stringent you are with your stop loss, you may cover the highs, you may just cover that. Completely up to you. Myself, I'm pretty content with just covering this and not covering the highs. If I hit stop loss here, I'll just re-enter up here when these highs are run, because chances are the equal highs will get run at that point, and it'll continue on down. That's kind of the advantage of the seconds entries, which we won't be doing here because that's not what this video is about. This is basically showing you a simplified Wyckoff schematic. Now, let's just go hit up the 10-minute. What do we have here? We have another demand level. Cool. Demand. So smart money's been refined in a lot of ways. By so many people, and there's so many different versions of this. And essentially, you're going to get into a lot of the same trades as the Wyckoff people. To me, this is simpler. Much simpler. I also don't want to, memorize all those names that they use. UTAGs and springs and signs of weakness and show strength or whatever it is. You just don't need to know any of that. If you know it and you use it, that's totally cool. You're going to end up in a lot of the same trades. We've just simplified this a lot. Again, you have a reaction point. You have a last sort of supply. Maybe it's cleaner on the 15. Maybe we'll pull the 15 in this case, just in case the zone doesn't actually get hit. Now, in theory, this is your redistribution in the simplified schematic. Or as I call it, basically just mitigation of the last flip zone. But this is basically Wyckoff simplified. So we're all about flip zones. Now, if we just look in here, once again, we have a chalk here. Cool. Now, this is probably hard to see. I know it's there on the seconds. So this would actually be somewhere I would consider putting in order. And obviously the extreme is always light. So I always look at the latest flip zone, which is this one. Now, it may come right through here and go to the extreme, which is totally fine. So that one came right through. We'd still be in that because our stop loss would not be exactly there. I can show you this on the seconds too. So you take that, usually you go 0.3 above. So this is your first place to take a trade. This is your next place if the stop came through that. That little wick above wouldn't have taken us out because we go at least 0.3 above. Cool. So we continue on down. Now, going back to the higher time frame, and we can look at the 10. You once again have a demand, which you break through. Maybe there's cleaner on the cleaner one somewhere. It's actually not bad. We're just gonna pull this zone. Now, something I want to mention too is the lower in the leg you get, the lower the probability of a trade is to happen. The only thing you have going is the slow is weak, so the expectation is to run this low. Whether it happens or not, you can never truly know. But the concept is, so the concept is that in theory, it should respect our system and respect supplies if we're breaking demands. Now here we wicked into our supply. To me, this is again a chalk here. No, it didn't run the highs. If you're wondering why this is a chalk, I'll tell you why. It does not have to run this high. In fact, that wick was caused by U.S. home sales, so it's a news wick. I disregard that. Aside from that, it touched supply, but right here we still went above, which means we still ran liquidity, which means this is my last form of demand. Cool. So rather than you sitting there and waiting for a Wyckoff schematic to set up, we're just looking for flip zones. And once again, because you're so low on the leg, I wouldn't be going for any more than 5 Rs here. So you hit your 5R pretty quick. This one here, you could have probably held a little longer because you're high up in the leg. So your 2-pip stop definitely covered you. You could probably go for 10R on that one, no problem. The first one that you got into, you can hold that bad boy for as long as you want because it's such a good entry. And basically, you can hold that one to at least run the 15-minute low. That being said, we're not retarded. We're going to pay ourselves along the way. because we just don't know how far the market's going. So the ultimate target is to run this low, which would have been 21.6R had you held full volume. Obviously, you're going to take something off every 10, 15, 20 pips because nothing in the market's guaranteed. The lower in the leg you get, the lower the probability of everything gets. So let's just carry on. At this point on Friday, you obviously wouldn't be in the market. If for some strange reason you decided to be, though, you once again have another flip zone. You have a demand here that was disrespected. You have a supply down here that disrespected the demand. So once again, you have a flip zone. Now, if we just look at this, so once again, you tap in, and once again here, so this to me is the last demand because it put in a high. It's probably hard to see on the 1 minute, but on the seconds, you can cleanly see that's your break. And ultimately, I would likely market execute this myself. You can see this on the seconds. Now this is, like I said, you are in discount. These are lower probability. If this comes through your stop, don't be surprised. You are being a little less safe now that pricing is no longer on your side. However, if it goes through, you can always get back in. And you can tell the market's losing volume. There's not a lot of drive. That being said, too, for myself, as soon as we got in here and this low is run, I would be break even on this. I have no risk in the market. Whether this trade goes or not is relevant. No, I wouldn't be in the market this late, especially on Friday. And no, I probably wouldn't even take this up because of how low down it is. But it just goes to show you how powerful order flow is. And our market structure says we're bearish and we should keep going down. And ultimately, market structure doesn't lie. And you can see the push to the downside continue. Now you can see the volume died completely. There's really no push. But again, lots of opportunities. Do you need to catch all these? No, you don't. One's good. Two at the most. I'd be out of the market. Now, so we started off with a complex Wyckoff schematic. Then we took the complex Wyckoff schematic and we turned it into this. Then we took this and we turned it into this. The only difference here is you kind of, you had a bit of a range. So it's more along the lines of something like this. And basically, the schematic's the same. You're looking for run liquidity, run of the lows, flip zone entry, flip zone entry, flip zone entry. Whether there's a range or you're following trend or you're going up and there's a range ahead of you going up, you're always going to be looking for these flip zones. So that's primarily what we push at Precision Markets. These are my go-to. This is, again, simplified schematic as far as Wyckoff's concerned. This is what I push. And ultimately, all you need to know is liquidity was run, the low was disrespected, and we're just looking for the supplies that cause the demands to fail. And ultimately, you pair that in line with market structure, you can have a high probability setup that could play out. Not guaranteed, but could. So just like we said, this low is weak and there's a chance it could be a target. It is a target. It's not guaranteed it's going to reach it. That's why we pay ourselves every 5R or every 10R, whatever your plan is. But you should have a plan to pay yourself. But ultimately, this is Wyckoff Simplified. And we're just using flip zones. Nothing complex. I hope you guys enjoyed the video. Have a great rest of your day.